So in this next presentation, we are going to be looking at domestic output and national income. So we're looking at that. Generally speaking, we talk about GDP and such things, and there are lots of different ways of measuring this domestic output. But we'll stick with that high level, if you will, when we talk about GDP, and that is GDP stands for gross domestic product. And at any rate, when we talk about real GDP versus nominal GDP, what that means is that we're adjusting for inflation. We're trying to adjust for, not just the dollars in your pocket, but adjusting for any kind of inflation that would be involved. That would get us to the real. That is typically for us as consumers, we're more concerned about real versus nominal. Nominal is the territory where when you're paying for things like, for taxes, for example, government, that's where government lives, is in nominal territory. Anyhow, GDP. So GDP again is gross domestic product, and the next step down from GDP is GNP, gross national product. The difference between and going from GNP rather, so we're descending, we're going down, we're drilling down on this. We take out depreciation to arrive at national income. So there are a couple of more steps along the way, net national product, etc. But at any rate, that's kind of the idea, is that we're starting from the top of the pile, if you will, GDP, going down to GNP, and then taking out the depreciation to get us to the national income. So GDP, again, gross domestic product, what that is that all the production all the production and economy in a domestic economy over a given period of time. So the producers of that could be like Toyota producing vehicles in Louisville, Kentucky, or wherever they're producing. They've got a number of factories in the U.S., so that would be counted toward that domestic production. But it would not include, for example, Ford production outside of the U.S., Ford production in places like Europe or Asia or whatnot. So that's kind of the distinction, if you will. So it's all the domestic production, regardless of like the home country of the producer, right? So that's GDP. GNP is where those dollars, those earnings are repatriated. So, for example, GNP, we just talked about Toyota. Toyota manufacturing in the U.S. and selling products built and, we using our domestic productive resources in the U.S. When we repatriate those earnings, we would send them back to Japan, for example. So all that Toyota, the sales of products that are produced in the U.S. by Toyota, those monies, if you will, would go back to Japan. Likewise, Ford of Europe, for example, would be repatriated. The dollars would be brought back in. So this is that move from GDP to GNP, gross domestic product, all that domestic production, regardless of the home country of the producer, and GNP, that production goes back, if you will, the sales, if you will, go back to the home country, wherever that company originates from, if you will. And just by happenstance in the U.S., there's not much difference. Some countries are different than that, but we'll get into that in a bit. So moving from that, from GNP, we have depreciation. And depreciation, and I'll be walking through that, why it is that we're why this is an important component. When we take out that depreciation, there are a couple of other items that will go along with it, but the consumption of fixed capital is one of the expressions that's used in the BEA where these numbers are tracked to get to national income, okay? Anyhow, onward we go. So we currently, again, we're looking at all these macro data. We're looking at the domestic production, and so in this case, again, we're looking at our $34.2 trillion in federal debt, and that was as of February 2024, and that number is going to go up, all right? Within the next 10 years, there's some CBO report, Congressional Budget Office report, that that 34.2 trillion could very well go top 50 trillion dollars again over the course of the next, I think it's 10 years, may have been 20 years, but continuing to rise over time. Okay, so GDP, when we drill down on GDP in terms of it's called the expenditure approach or production. So if we're looking at the production piece of this, the stuff that's actually being produced out there in the economy, we have the PCE, GPDI, GC&GI, and NEGS. So these are all things that stack up to get us to that GDP number. PCE is personal consumption expenditures, so that's the household spending on durable goods and non-durable goods that are being produced at the firm and being sold to the household as consumer. GPDI, gross private domestic investment, and government spending, and also this net exports or exports really. Those are all non-consumption spending, if you will. Again, not PCE, but GPDI would be again gross private domestic investment. That would be the robots and the equipment that goes into a firm, if you will. Again, physical capital is what we're focusing on here, right? So that would be like the physical capital. Underlying part of that would be the financial capital, but at any rate, you get the idea. GC and GI, that has to do with government spending. GC is government consumption expenditures. So these are short-term expenditures. For example, the vehicle, the gasoline that goes into the government vehicle, for example, et cetera, along those lines. That would be that government consumption expenditures, short-term things. And in parlance, with the idea being in a business, these would be expense item versus capital items. So those are the expense items. The capital items would be the GI or the gross investment. This is in the public sector as opposed to the private sector. Gross investment, just as an example, aircraft carrier. Okay. Lastly, NEGS, net exports of goods and services. This is exports minus imports. And it just so happens that our imports exceed our exports. We have trade deficits, right? So this is a negative number. So that takes away, if you will, from GDP. And the reason being is that exports are produced in this country. Income flows in this country from the production of those exports, as opposed to imports where they're not being produced here. So it's taking away. It's a withdrawal, if you will. So anyways, back to our discussion on real versus nominal. So you have a dollar today. 1 year down the road with 10% inflation reduces the value of that dollar by 10 cents down to 90 cents. Nominal dollar today, that dollar in your pocket, or in your wallet, put it away for a year, take it back out again. Yes, you still have $1. This is that nominal piece, what we our current dollars, if you will, the dollars that you have in your possession today, and if they don't go anywhere, they're still there in a year. Nominally, there's no difference. In real terms, if there's 10% inflation, that dollar is reduced by 10% value, right? So GDP, again, we were talking about the spending side or the expenditure side, and that has to do with. So when we talk about GDP, they're like two sides of the same coin, meaning that the expenditures or the production versus the income, okay? So spending or expenditures, again, would be that PCE plus the GPDI plus the GC and GI plus the net exports of goods and services. Since imports exceed exports, it would typically be a negative number. It has been in the U.S. for more than 20 years, more than 25 years, I guess. Maybe 30 years now that I think about it. But at any rate, again, these are expenditures. Expenditures, production, think about that in the same manner. So PCE represents about, these are a little dated, may have been from a couple years ago, represents about 68% of that GDP. So the lion's share of that GDP goes to where? To consumption. Next, we're looking at the GPDI. It's about the same as at the government level at about 17-18%. And again, that net exports of goods and services is a negative number because imports exceed exports. So the flip side of that same coin we just looked at the expenditure side or the production side, is income. Income, we break that down into that income that's flowing back from the firm to the household in the form of wages, rent, profits, interest, right? Um, at any rate, flowing back to the owners of those productive resources. So first, we're looking at income. Drilling down on that income. It's broken down into wages at 62%. So again, that's the largest portion of that GDP from the income side, if you will, at 62%. Small business profit would be about 8%. Rent going to for the land and also for those minerals that are taken from that land account for about 4%. Other profits, corporate profits, if you will, larger companies profits in the form. I'm not sure if profit sharing for labor would be included. It should be, but at any rate, this is another form of profit along with that small business that we just talked about above. Interest are again interest payments for loans, for bonds, bills, notes, and bonds, etc. The interest that flows through in terms of that income. Okay, and finally, transfer payments. While it's not income, nonetheless, transfer payments are still flowing back to the household and in the form of a quasi income or something that's going to add to your spending power, your purchasing power ability. Okay. So now more specifically, when we look at GDP, gross domestic product, from the production side, that all the production in the domestic country, regardless of that home country of the firm, meaning again, pointing to that Toyota production in the U.S., also Ford production in the U.S. So it doesn't matter the brand or the label or where the home country is at, whatever it's produced in the U.S., that counts toward GDP. As opposed to GNP, gross national product, we're repatriating rather income back to that home country. So Toyota production in the U.S. goes back to Japan, the value, if you will, right? Ford of Europe, meanwhile, flows back into the U.S. So Ford in the U.S., of course, remains as part of that gross national product. So we're walking again from GDP down to national income, and this is an example from the year 2020. We started with a nominal GDP of $20.9 trillion. So the income receipts from the rest of the world amounted to $1 trillion, less the interest payments going out, that $0.8 trillion. So we're walking back toward GNP. So what's coming in from Ford of Europe, for example, accounted to about $1 trillion, and the payments going out amounted to about 800 billion, pretty close, right? So that GNP adjusted downward by just a touch, by a couple hundred billion from 20.9 trillion. It actually went up, up to 21.1 trillion. I had it backwards up above. The receipts exceeded the payments to the rest of the world. At any rate, that's why it gets us up 200 billion rather than down that I was thinking about. So onward we go. So next, what we're doing is we're going to be taking out consumption of fixed capital, depreciation. So that amounted to, this is an expense item. I'll drill into this a bit more, but talk about it a bit more, more explicitly. But this is that progression going down through the NIPA tables when we're looking at GDP, and then there are a whole bunch of other things that come into play. But this is basically the largest chunk of it would be that depreciation. There are other things, including NNP, which is net national product, but we'll stick with kind of the above. So moving from 21.1 trillion down to that national income level of $17.7 trillion. And again, we've got our circular flow on the right where we're, where we can kind of visualize, if you will, what we're talking about in terms of that production versus that income. The production piece of it, flip side of the same coin of that GDP, for example, that's on the top, that output mix, the goods and services, that personal consumption expenditure, then the non-consumption spending on the right-hand side, investment, government expenditures, exports, but don't forget to do what? subtract those imports. So if we had to think about this in terms of like what is a better metric? What is a better way to measure why we brought up national income? That's probably a better way of like looking at the health, if you will, of the country, because when it comes down to it, what we care about is our income. Let me just walk through this process here. So when we're looking at depreciation, we're double counting, and there's a problem associated with this when we talk about GDP, because we're kind of mixing apples and oranges when we're talking about on a cash basis versus depreciation. But we'll just walk through this. So there's a $50,000 truck that's sold in year one. Um, and that's counted, it's a new vehicle, so it's counted toward GDP in year one. Year two, the firm is using that truck, right? So they're using that truck up. All right, remember this is where the depreciation expense comes in, and there might be a depreciation schedule, like say 5 years, so 1/5 a year, unless there's some other sort of depreciation, but we'll keep it simple. So the firm sells $100,000 in final goods, and that's added to that second year GDP. Makes sense. They sold $100,000 of final goods. But embedded in that $100,000 is $10,000 of depreciation on that truck that was purchased the previous year. Again, we're depreciating this vehicle over the course of those 5 years. So in this case, when we're talking about that $100,000, it's overstated. We're saying that GDP overstates it to the tune of $10,000, in excess of where it really ought to be. That $100,000 should really be only $90,000 because of that depreciation. Hopefully that is somewhat clear for you. This is an accounting artifice, and I don't see an artifice. This is the way the accounting part of it works. The reality is that GDP kind of overstates that actual production, if you will. Anyway, so I want to throw this out here. There's a term aggregate demand that comes up, and as you would expect when we're talking about aggregate demand, what we're saying is that overall demand. And it behaves in a similar manner to regular demand curve, sloping downward to the right. However, when we're talking about aggregate demand, we're looking at the price level on the y-axis, the vertical axis, and we're looking on the bottom axis, the horizontal axis, or the x-axis. That has to do with real output, what we're actually producing in that economy, which is, again, not dissimilar to that demand, that quantity demanded. But when we want to think about when we're looking at aggregate demand, first off, it's equivalent to that personal consumption expenditures plus those injections, the non-consumption spending, that GPDI, GCE, and GI, and NEGS. So we're thinking is pretty much the same as GDP. However, we want to make sure that we're thinking about this demand versus quantity demanded. We're looking at that entire curve, right? That's kind of the focus. So GDP is equal to that quantity demanded specific value price related to that quantity demanded, as opposed to aggregate demand, which is that entire demand curve. So we're looking at that in the demand curve in its entirety. This is just a quick intro, just so that you're if not, you're at least acquainted with this idea. So again, onward we go. So again, for example, we're looking at the data. This is coming from the Bureau of Economic Analysis, and we're looking at personal savings. So we're drilling down. Remember, we went from GDP to drilling down to that GNP and then on to national income. Point being that we're going to drill down even further. We're going to get to drilling down into that income, what it consists of, and so on and so forth. Anyhow, so we're back to 2020 again. Have to update this at some point, but this is good enough now for example's sake. So $20.9 trillion in GDP. Again, these are nominal dollars. These are in our wallets, right? Less depreciation of $3.6 trillion, getting us, that was the GNP was at 21.1 trillion, and then less the depreciation of 3.6 trillion gets us to that $17.7 trillion in national income. Again, a couple of more steps in there, but that's kind of in essence what we're looking at. From that, we want to take out corporate profits, $2.2 trillion, taxes on production, $0.8 trillion, contributions to Social Security and Medicare, $1.5 trillion, and interest paid on the debt, $0.6 trillion. Of course, that number is going to be going up. So that gets us, we're pulling these numbers out, and then we're adding back in transfer payments, personal transfer payments flowing back into the individuals, back to the household. Transfer receipts, transfer payments, and then also transfer receipts to the tune of $4.2 trillion that are added back in. Transfer receipts would include such things as block grants going from federal government to state government for like Medicaid, other issues, things along those lines. At any rate, that gets us to our personal income of $19.6 trillion. Not a huge difference, but nonetheless, we're at that personal income level of about $19.6 trillion. Then we take out our personal taxes, income tax in essence is what we're saying, to the tune of that $2.2 trillion. We arrive then at our disposable personal income. Remember, income goes to taxes, consumption, and then whatever's left over is saving. So personal outlays would be just that, our consumption. So we take out 14.5 trillion, gets us to our personal savings so far as, again, the NIPA is at 2.9%. The personal savings as a percentage of disposable income, and this is year 2020, was 16.6%. Extremely high, more than double of what it normally would be, which would be 7% or even lower than that. The reason that it was up so high in 2020 was because of, yes, you guessed it, COVID. And there were stimulus packages that were where money was flowing, if you will, from the federal government, right? That was being kicked out, and we ended up with more income than not more income than we needed, but we didn't have enough goods and services. There weren't enough available that would be out there. Again, GDP, when we talk about finished goods versus value added, this is again, just to kind of give you an idea what we're talking about. Finished goods are, you have the vehicle. You buy a new vehicle, included in that new vehicle are new tires, new everything, right? As opposed to the value added side, what that means is that we're taking it apart. Like, we're blowing up the vehicle and then putting it back together again, and we're adding value to that construction of that vehicle. The GDP is built up that way, and it's all about taxes, because this is where if you ever heard the term VAT, value-added taxes, this is kind of where it comes in when you're picking apart the components, and this is very common in places like in Europe. I'm sure it's elsewhere similar to that. We don't really have that set up in the U.S. So again, we're looking at this. In this case, we're looking at the year 2020. Again, a little dated, but similar to this. And so we're breaking this down. Transfer payments. Remember, when we talk about transfer payments, those are payments being made to the household from government, and without a connection with income. Strictly speaking, from in economics, in order to earn income, that has to do with the relationship between the use of your productive resources, the current productive resources, and the compensation flowing to you from the use of those productive resources, as opposed to transfer payments. There's a disconnect there, meaning you may have earned it in the past, and like the benefit associated with Social Security, or you may not have ever earned it if it's some sort of a welfare payment or along those lines. So that's what we mean by transfer payments. $4.3 trillion total expenditures, as in spending at the government level. Again, for the year 2020, expenditures were $6.9 trillion. Total receipts amounted to $3.7 trillion. So this is where our deficits are born. Net lending or borrowing to the tune of $3.2 trillion. And on the right-hand side, another similar breakout of the different components. Drilling down on when we're talking about current receipts, what those current receipts are, where they're coming from. And one to note, of course, or not of course, but one that I always think about is the Federal Reserve banks. Those are funds that are flowing for the interest that is earned on the U.S. Treasury securities in their possession. They donate 90 or donate they give back, if you will, to the government. I guess that's a donation of sorts. 95% of all the interest that they earn. But this has changed, so kind of keep this in mind. These numbers are fluid and they can go up and down. And anyhow, the top part, the current receipts, all the way down to current expenditures. These are all the receipts that are flowing in versus the current expenditures, and it's kind of blocked here on the right-hand side, but you get the idea. Current expenditures amounted to $6.8 trillion. And included here, and of course, would be interest payments down below. At any rate, this is kind of breaking it out a bit for us to see. Again, somehow this is blocked a bit on the right-hand side, but we'll just talk through it. So, flow of funds from the Federal Reserve. This is when we're looking at this personal savings rate here. This has to do with. You'll notice that the numbers are. I'm not saying that they're necessarily low, but this. Remember, income goes to where? It goes to paying taxes, consumption, and the residual is your savings. This is our savings, our personal saving rate over the years. And what you'll notice is that there's a huge spike. It's hard to see this here, but there's a huge spike in the year 2020, and this would have been associated in this time frame where it's significantly higher is associated with the stimulus payments. So those stimulus payments flowing from government to households, to individuals in those households, and as a result of which you have more money going into your savings account, and it gets depleted. It's not going to last there forever, but there's a huge influx, if you will, of cash. So the personal savings rate, it was reflected in that. And this, if you go back through the years, again, basically we're talking about anywhere from 4 or 5%, maybe 7%. That was about the max. And then during COVID, when there was massive injections in the form of stimulus payments that popped over 30%, just absolutely crazy. So again, we're looking at the walk from GDP. So this is again from the NIPA, the National Income Products Account, through the Bureau of Economic Analysis, which is a department, if you will, which is a bureau under the Department of Commerce. So it's kind of the drill down, Department of Commerce down to Bureau of Economic Analysis, and then these forms that are built, the tables are coming from National Income Product Account. So this is our accounting system, so to speak, right? Anyhow, before we do that, or as in conjunction with that, when we talk about stocks versus flows, stock would be a balance sheet, a snapshot of any given time. In this case, we're looking at February 2023. Our overall debt picture was at $31.5 trillion. So whenever we're talking about the debt, that would be considered a stock or a balance sheet item where we're at that given point in time, versus a flow, which would be like an income statement. And that's where we have deficits introduced. So the deficit for this would be for the fiscal year 2021, in this case going from October 1st, 2020 through September 30, 2021, amounted to $2.8 trillion. And that, of course, gets transferred from that income statement to that balance sheet, starting fresh with the new fiscal year. And if you have increased deficits at the end, then that gets transferred back again onto that balance sheet. It's conjunction with it going along, but you get the idea is that the income statement is a flow, how much it was over a period of time versus the balance sheet where it's at that specific period of time. On the right-hand side, again, is a walkthrough from GDP down to personal income. So GDP in 2020, for example, we'll stick with that year, $20.9 trillion, less or adding income receipts from the rest of the world, less the income payments to the rest of the world. Guess that's a little bit higher GNP because we have more receipts flowing in than going out. Hence, we end up with a $21.1 trillion GNP. Then the big item here is that consumption of fixed capital. There's more stuff that kind of flows in here, but that $3.6 trillion kind of is the big number that gets us from that 21 trillion down to the 17.6 trillion dollars for that net national product, which is essentially the same as that net national income. And we won't really discuss what these items are. Nonetheless, these are the steps that we're kind of drilling down on to get to something that we're really ultimately trying to get to that income piece, right? So from that national income, we make our adjustmts to get to that personal income, and it's up a little bit because we're getting some transfer payments that would be flowing through, and get us going from 17.7 back up to closer to that $20 trillion. And from that, again, we've got the breakout and walking through. We'll get on the next page. Or the next little piece, we'll start talking more about that income piece that would be associated with this. So before we talked about the flow of funds, that would be the Federal Reserve, where we talk about the savings rate and so on and so forth. And I'll briefly speak to that. It's not part of our illustration here, but we'll start with the illustration. So personal income, again, we're at that $19.6 trillion. And then we break out that income down to, we're drilling down on that. So we're getting rid of our, walking from there down to, we're showing our taxes and gets us to our disposable personal income. All this other stuff in here breaks out that income, what that income is coming from, where it's coming from, right? So personal taxes, that's our income to income taxes in essence, and there's probably a little more in there, but that's in general, that's what we're speaking to. That gets us to our DPI, or disposable personal income, of 17.4 trillion, less our personal outlays of 14.6 trillion. Those are our expenditures. That's our consumption. So taxes, remember, income less the taxes gets us to our disposable income, disposable personal income in this case, less the outlays, which are personal consumption expenditures in essence, and a few other items that would be in here as well, gets us to our personal savings amount of $2.9 trillion in 2020. So that's the residual. That's what's left over from that personal income of 19.6 trillion, is that saving of $2.9 trillion. And what that amounts to when we start looking at it in terms of our disposable income, remember our disposable income is after-tax income, that gets to us to a 16.6 level. And how much of our disposable income that we're actually saving. This is an enormous amount. This is much, much more than it typically is, and frankly, much more than it really should be. If we were there, forget about the should be part, but the point is that it's significantly higher than typically has been, and that's because of lots of these stimulus payments that were flowing in from government in this time frame. So anyhow, disposable personal income at the bottom, that 7.5%, versus that 6.2. This is the change from the preceding period, so it's gone up quite a bit. At any rate, the takeaway from this is that walking from that personal income through taxes, through consumption, expenditures, and the residual left over gets us to our saving. So this is that net result of our savings. I think there was a bit more I wanted to cover, but that's going to suffice for now.